Welcome to The Explainer. Today we're jumping right into investor Peter Schiff's argument for a massive bull market in precious metals, one he says is powerful but almost completely overlooked. We're going to unpack the logic behind a rally that's happening right under our noses but is totally off the media's radar.
Okay, let's start with just one number, and it's a pretty startling one. According to the source material, this is the year-to-date performance of gold mining stocks. And no, that's not a typo. We're talking over 90%.
And this really sets up the central mystery we're going to explore. You've got a sector that is absolutely crushing everything else in the market. But when you turn on the financial news, it's crickets. So what's going on here? Let's find out.
So just how big is this quiet outperformance? Well, we're not just talking about some minor blip on the screen. According to Schiff, this is a major structural shift that the mainstream is somehow completely missing.
And this right here just perfectly illustrates the disconnect. Newmont is the #1 performing stock in the entire S&P 500. It's beaten every single one of those high-flying tech darlings we hear about 24/7, and yet, get this, it's cited as one of the least-owned stocks in the index by big institutional investors. The top performer, and nobody owns it. That is a huge, huge red flag.
Now, what's really fascinating is that, according to Schiff, this weird behavior in the stock market, it's just a symptom. It's a sign of a much deeper problem with the official economic story that we're all being told.
The source argues that the Federal Reserve has the whole story completely backward. The Fed keeps saying the labor market is strong and inflation is weak. But Schiff's reality, based on the data he points to, is the exact opposite. We've got a weak labor market and strong rising inflation. And that, he says, is the crack in the foundation that's quietly pushing capital towards gold.
And he backs this up by saying you just have to look one layer deeper than the official numbers. I mean, sure, the headline unemployment rate looks good, but the broader U6 rate that includes discouraged and underemployed workers is sitting at a recessionary 8.1%. He also points to an outright job decline in June and barely any growth in August that's clear signs of weakness, not strength.
So this brings us to the crucial point, what he calls a major policy error. The Fed is actually talking about cutting interest rates at a time when inflation is still way above its target and actually going up. The source claims this is the complete opposite of what a central bank should be doing, and that this move is going to seriously hurt the dollar's credibility and basically act like rocket fuel for gold.
So, how does all of this build the case for where gold is headed? Well, according to Schiff, the story really starts with its long-term price action. And this isn't some short-term trade. We're talking about a multi-decade story unfolding.
The source really highlights this chart, arguing that the 13 years gold spent going sideways wasn't wasted time at all. It was building a gigantic support floor. You see, the first bull leg was a 6-fold increase. Now, after breaking out from that massive base, a whole new leg has begun.
And that brings us to this number, $12,000. This is Schiff's minimum price target for gold. It's based on a pretty simple symmetrical idea. If the last big bull run was a 6-fold increase from its base, then a similar 6-fold move from this new much higher $2,000 base gets you to 12 grand.
Now, what's driving this? A big part of it is the dollar's own decline. This number here represents the loss of the US dollar's value against gold, just in the last 3 years. A 50% devaluation in 36 months. And it's not just regular investors who are taking notice of this.
The source argues that foreign central banks see the writing on the wall. They've been the biggest buyers of gold for the last couple of years, quietly stacking it up to replace their US dollar reserves. They're basically hedging against a potential dollar crisis and positioning gold as the go-to reserve asset of the future.
So while gold has already broken out and is starting to make some headlines, the source argues that the next, maybe even more explosive move could come from its sister metal, silver. He describes it as a tightly coiled spring.
This chart really puts things into perspective. Silver's current price might seem high to some, but it's not even close to its 1980 peak when you adjust for all the inflation since then. That old high would be almost $200 an ounce today. That just shows you how much room this thing potentially has to run.
And according to the source, this move can happen incredibly fast. He points to this major resistance level around $50 an ounce. He's saying that once that level breaks, you could see a massive short squeeze that propels the price up toward $100 in a matter of months, not years.
You know, Schiff reframes this whole debate. He says it's not really an investment. It's more of a consumer choice. He compares government fiat money, like the dollar, to an old, clunky taxi that's inefficient and always losing value. And then he says gold is like the free market's Uber, a way better, more reliable alternative that actually holds its value. And with new tech, it's easier to use than ever.
So if the case is really this compelling, why isn't it mainstream? Why isn't everybody talking about this? Well, that brings us to the final and maybe most crucial point from the source, the investor's blind spot. The source draws a direct contrast between the billions spent marketing Bitcoin versus gold's completely silent rally. I mean, think about it. Super Bowl ads, celebrity endorsements, all this hype. And yet, Bitcoin has actually been losing value compared to gold for the last 4 years. He argues that investors have been totally distracted by marketing while the real move was happening quietly in gold.
But here's the twist. Schiff says the lack of attention is actually a feature, not a bug. He likes it. It lets the early investors build their positions before Wall Street eventually catches on, packages the story, marks up the price, and sells it to the public. The silence is the opportunity.
And that brings us right back to where we started, this huge disconnect between what's happening in the market and what the media is telling us. Schiff's whole argument is built on the idea that this gap, that is the opportunity. And it leaves every one of us with a pretty important question. What happens when the rest of the world finally decides to look?